Good morning, Daniel.
Good morning. How are you?
I'm pretty good. Calling here from Durham, New Hampshire. And are you in the big city?
Yes,
Or
I
is
am.
all right. Very cool. All right. Very good. All right. Let me get this going here. Can you hear me good?
Yes, I can. Just give me one
Yeah.
second. Look at my
And
cell phone.
yeah, you're coming in loud and clear, so that sounds good. All right.
So
Right.
the
So
San Francisco background. What's going on
yeah,
there?
that's actually where I started my career, and I always liked the picture of the bridge. And I lived in a houseboat actually in Sausalito back in the 80s. My uncle owned multifamily in the city, so I did all the renovating, fix up, etc. on his operation. So that's kind of how I cut my teeth in it. And I used to ride my bike over the bridge all the time. So I don't know if you can, I don't know if it's safe to do that anymore. Um, but yeah, it's a special little spot for me. But I'm a New Hampshire guy, and I moved back to my roots many years ago. I live in the university town here, Durham, New Hampshire, um, and this is where the podcast is coming out of. So, all
All right,
right,
I don't know what's going on with my camera. Just give me one second. Sausalito's a dream, though.
yeah,
Oh
it
yeah.
must be so high end right now. It must be just unaffordable for except the very very elite top. I would say that's my guess. I've not been back there in quite a while actually. Um,
Yeah, I was over there and I was living in San Francisco in 2018, in summer of 2018.
oh my, all right, much more recent than me. There we go. Well, it's a pleasure to have you on the show here. Um, you've been doing work with Strand Capital and EM Capital Management. You've got insights on data-centric real estate, private markets, and you've scaled EM Capital's single-family residential SFR portfolio. This is tremendous here to have you on the show. So we'll get set up and get going in just a couple minutes here. Um, you've probably been on podcasts before, is my guess, Daniel.
Yeah, I've been on
Yeah,
a few.
yeah. Okay, cool. Yeah, so it'll be conversational in nature, and I'm gonna give you some questions, but just take it and run with it where you want to run with those questions, and that's always more interesting. And your insights and opinions, especially, would be really beneficial here in your experience to share with listeners. So, yeah, um,
Can you tell
yeah.
me a little bit more about how you started or why you started the podcast and where it's going and who your audience is, who your audience is?
Right. And typically my audience seems to be people that have got experience in real estate at higher levels. Um, I I have a kind of a mixed audience. I get a lot of younger people looking at it, and that's why I usually ask those questions about experience. And for example, what was the shining light moment for you when you got going in real estate? And what was your toughest problem you ever had to solve? Those are always good ones there. But I started doing this because I'm retirement age, and I challenged myself 3 years ago to buy a property without seeing it using just technology. And I did it. So I bought it was an SFR, very large property actually in Mansfield, Texas. And I turned it into a co-living property. And I did that all without seeing it. And I still have not seen it physically. So for me, it's about, not uh, kind of dating myself. Yeah, I mean, I'm upfront with people. I'm 67 years old, but technology is here and now, and we got to use it for our own benefit and for the benefit of our companies. So, Um, yeah, and uh, as far as the real estate field in general, I have a smaller portfolio. I have 25 units in various buildings, usually a quad. I have a bunch of quads and a 6 unit. So that's kind of my niche, but it's run passively now, and I'm focusing more on the podcast as an outlet for my desire to get out there and find out more from people who are in the field and have made big differences in the real estate field. So I mean
I
that.
feel like it's way more fun too, right? Like
Well
a
said.
little bit different dealing with like evictions or tenant issues with payments being on time and kind of the ethical dilemmas of being a landlord versus, yeah,
Yeah,
meeting new people, learning about new strategies is why I like going on these a lot.
nice.
Always feel like I pick up some nugget or I'm able to walk away a little smarter than when I walked in.
Yeah, there we go. Okay, well, so we're going to jump in, start with your background, the industry trends that you're seeing, Daniel, especially in the private markets and institutional real estate, and then discuss, say, current challenges in data-driven investing. So, where you see the market heading, that's a biggie right there, based on your experience. What's going to be coming down the road in the next 2 to 5 years, based on the technology we're using right now, and where do you see things going? So, yeah. And
Yeah.
all right. Yeah, all
Well,
right.
whenever
So
you're ready to get started, I don't know if we're on the clock yet officially, but I'm ready when you are.
that's great. Yeah. Okay. So I'd like to welcome all our listeners to the podcast today. And we have Daniel Erb with us today, who's the co-founder and CEO of Strand Capital. Um, we're going to go ahead and welcome to the show, Daniel. I mean, great to have you here. So we're going to jump right in and perhaps have you share a bit about your role as co-founder and CEO. All right, how does this fit into the broader landscape of data-centric real estate, private equity, your specialty here, amongst other things? How does that
Yeah.
fit into that? Yeah.
So I was a former investment banker, and yeah, I got the interest to buy real estate when COVID came around.
Okay.
And so working 100 hours a week to pencils down on every deal. Um, I'm Catholic, grew up with a Catholic mother, so idle hands leave room for the devil, or idle hands is the devil's playground. So
Yeah.
I
Yeah.
so I wanted to stay busy and started looking into investing into real estate. And yeah, we did some things well, we did some things wrong. But that first property really, started an addiction. And I started raising money. And as I started raising money from outside parties, I left investment banking to pursue full time building out an investment platform.
Okay.
Um, EM Capital is the first real estate fund I built. I still have that to this day, and I'm a significant owner in that portfolio. And Strand Capital was a larger institutional tailored vehicle where we were basically trying to build out what we did with EM Capital just at a much larger scale.
Okay. All right. So, what does a typical day look for you, Daniel? Here, you're balancing your strategic vision, capital formation, investment execution. Well, what's a typical day like for you there?
Yeah, I spend a lot of my day talking to people.
Okay.
I have a team behind me of operators, folks that are executing on day-to-day tasks. And my responsibility, I feel like, is to understand the market, what investors are looking for right now, how we can add value to folks in our audience and build up distribution channel. And so really my day is focused on talking to potential investors into one of our funds, speaking to advisory clients, um, really understanding what is going on in the capital markets world, and making sure that all of our existing investors have their questions answered, and are having a positive experience being a part of one of my platforms.
Right. All right. And what major shifts are you seeing right now in the private markets and institutional real estate right now, particularly concerning the adoption of predictive analytics of AI here?
Yeah, so I think that I think AI is well, I think everyone does. AI is going to change a lot of what we do.
Okay.
And yeah, one of the unique kind of experiences or viewpoints that I have is from a learning and development lens.
Okay.
So when I left investment banking and started buying real estate, I didn't want to take a salary quite yet out of the real estate investments because I wanted to make sure we were able to grow. And so I picked up part-time work, and one of the engagements that I've found to be, very, very positive for me has been teaching. And so I train
Oh.
a lot of investment banks and private equity firms and university students on how to get into high finance careers, what are the technical skills required, and how to navigate that world as you move from analyst to associate, or from college senior to first year analyst to private equity associate.
Mhm.
And I found that really rewarding. But one of the unique aspects of it is that I get to see firsthand how some of the biggest financial institutions in the world are thinking about AI and how that
Oh.
is shaping their learning and development. Um, and so I think from my standpoint, it's AI has already changed everything. I
Okay.
don't think it's in the way that a lot of people fear, which is, a one-to-one job replacement, like an AI becoming or coming in and taking over Bill Knowles and his job, and now Bill Knowles has nothing to do. That's not really where AI is headed, but definitely in terms of deep research, data aggregation, and intelligence being democratized.
Okay.
Uh, those things are already kind of accomplished by that.
Okay. Any more detail on that? That's a fascinating area right there. The data
Yes,
aggregation. Yeah. Yeah. Hmm.
I think that what I've seen is that there's some investment banks, there's some firms that are investing a lot into building out the best analyst class.
Hmm.
And building out the most intelligent group of people with various backgrounds, and then they're employing, us as instructors to actually teach these folks finance through AI, along with traditional finance training. And to me, that signals something that the analyst classes continue to grow at the biggest places. And what these analysts are able to accomplish are now 10x what a traditional first year analyst was able to do. And then there's this group of firms that are more so seeing this as a cost saving thing, where they no longer need to hire this big analyst class, that instead they could bring in one or two mid-level type employees that already know what they're doing, and can leverage AI to be you the work of a junior analyst on their team. And
Okay.
so there's a little bit of this bifurcation between how investment banks, private equity firms, financial institutions are thinking about AI and how they are training their juniors and future of the firm on
Okay.
their skill.
Hmm. Hmm. How has the current macroeconomic climate impacted your investment strategies at Strand Capital? What trends are you observing in capital allocation and underwriting right now?
Yeah, so with my company EM Capital, what we've done is we've broken or we've basically spun out this advisory part of the company into EM Capital Management. And th this was largely from my experience at Strand and what
Hmm.
is going on in the capital markets. So when we were raising that institutional vehicle, something that really stood out to me when I started talking with independent registered investment advisors and small to mid-sized family offices was that there is this gap between institutional grade analysis and underwriting and you know the infrastructure that's in place at some of these firms. And what I've noticed is that there is such a saturation of private investments and
Hmm.
registered investment advisors in particular who are largely investing on the behalf of high net worth and ultra high net worth individuals, they're underallocated to private markets. On average, only about 2% of RIAs books are allocated to alternative assets. And when
Hmm.
you compare that to an institution or a multifamily office or a kind of step up in terms of professional investors, that
Hmm.
that percentage is actually closer to 26, 27%.
Oh, yeah,
And so we're
interesting.
seeing all of these folks run at alternatives.
Hmm.
And it's a way to differentiate your business if you are an RIA and you're trying to recruit other advisors, as well as if you are eventually going to be aggregated into a bigger platform.
Yeah.
Having long duration, low volatility investments in your book or a differentiated alts desk is a huge value. And
Yeah.
so folks want this capability and there's opportunities to deploy, but it's almost like private markets has outgrown the infrastructure that's in place at some of these investment firms.
Okay. Okay. All right. Well, what's working well for you right now in leveraging data for investment decisions? And what have been some of the more frustrating challenges that you may have experienced in this kind of evolving space? Yeah, some specific challenges would be great here.
Yeah, I would say that one thing that is always a challenge with AI, and I think it's something that folks are starting to pick up on, is that your large language model is built to make you happy.
Hmm.
When it comes to investing, you want an objective view. There's a reason why, friends and money or family and money, there's a stigma attached to it. And it's
Hmm.
kind of the same with using your LLM, who is really attempting to be your friend to make investment decisions for you. And that's something that I didn't even realize was happening until I actually started working on the buy side, doing diligence. And what was the process that was in place? And it would be, we're going to take a few different PPMs and we're going to put them into ChatGPT and we're going to
Hmm.
task ChatGPT to tell us which has the best terms. And you miss a lot of that. You miss a lot of the underwriting experience when you're really getting to understand this deal and what are the key levers for returns.
Yeah.
And that truthfully, the best investments only have one or two things that need to happen for, the projection to be hit. Every deal has assumptions. but you want to, as a investor, find opportunities where you believe that the market is wrong about something. And that's how
Uh-huh.
you're able to drive outperformance or drive alpha. And so I think that where AI has really fallen short is that it's never really taking a contrarian view at
Okay.
an initial glance. So when I put in those three, PPMs and I say ChatGPT, which one is the best one? ChatGPT is going to look for historical performance and look at the fund that has the best run rate type returns or the investment that has the strongest track record of the sponsor. But it's not going to take the deeper level look that you really would want from this
Yeah.
very powerful, intelligent machine, which is to say, okay, what really matters for this investment to go well?
Yeah.
Is this something that I believe as a professional investor is going to happen? And when those two things align, that's when I think that AI is really able to supplement this process. But
Okay.
replacing, your investment decision, artificial intelligence, I think is a little bit away from that.
Yeah. Right. Okay. Which metrics are you most focused on right now, Daniel? To improve or enhance investment performance and scale your SFR portfolios.
Yeah, so
What?
something that we did within SFR was we built this Rezi Alpha tool,
Okay.
which basically is something that we've been working on since I founded EM Capital, which is a supply and demand forecast model. And so it sounds simple. It's just economics 101, supply and demand modeling. But how do we go 3, 4 years out on that? And when we were building this originally, it was all done in Excel. So my partner, he had a background at BlackRock and T. Rowe Price, and he was building these for oil and gas stocks, this sort of
Hmm.
supply and demand model. And we
Hmm.
took that model and we built one for single family. And
Okay.
then as technology advanced, we were able to improve that formula by adding more empirical variables
Hmm.
into our analysis, along with real-time web scraping.
Hmm.
And we can now pull all of the KPIs that we look for across the country by MSA for multiple years. And we can back test this algorithm that we built starting in 2022. And so no longer is it this hypothetical, we are fundamental investors and we believe in supply and demand, and that this market is going to have this much in household formation and has this much in permit data. It's become, let me log into the Resi Alpha. Let me look at the MSA. Let me do a deep dive on all these different demographic and KPIs that are pulled out. And let's compare it with other markets that are of similar size. And then let's take a 10,000-foot view and look across the country to see maybe if there's a better market for us. And I think what is really exciting about this juncture now, and the advisor work that we've been doing with registered investment advisors and family offices is, we took this Resi Alpha tool, this supply and demand forecast modeling, and we've been
Hmm.
able to now build it across all commercial real estate asset classes. And so you're
Okay.
asking me today in 2026, sitting in June, where I would be investing my money. I don't know if it's necessarily single family anymore versus retail or even multifamily. Now that starts have really subdued following the big supply push in 25. Um, there's opportunities right now in some asset classes that I think people are missing. Um, and it's almost like data centers and AI has kind of brought people's focus, to non-traditional real estate investments. And those
Hmm.
more traditional real estate investments, I think, are starting to become, real opportunities.
Mm. Um, what do you see for retail and commercial? You hinted at that a little bit there. It's been struggling, but for conversion, for example, is there opportunity in that area coming?
When I think about retail specifically, I think strip malls, places where supply is not being built and occupancy is at record highs. And so if you look at, kind of boring investments or more, compared to data centers at least, but a strip mall,
Yeah.
where these sort of commercial venues are not being built anymore.
Mm.
So there's no real new supply being added, and there's more independent entrepreneurs. Franchising has become more democratized and demystified, and so you're seeing a lot more interest in these sort of businesses that,
Uh-huh.
in general, benefits retail. And so you see some positive demand tailwinds in the asset class,
Hmm.
and
Hmm.
at the same time, there is really no new supply being added.
Okay.
And so you can get that very strong yield that comes with a secondary or tertiary retail investment. And at the same time, I think that the appreciation or the capital gain is a little bit higher than most people appreciate.
Huh. There's some good insight in there. Where do you want Strand Capital to be 6 or 12 months from now in terms of market position and assets under management growth? What do you see ahead for the next year for the company?
Yeah, so I would say that for me, my priority is on building out productionalized AI. Um, and yeah, this is through my experience at EM Capital, through my experience at Strand Capital, using our investment intelligence and research machine internally. And seeing if this is something that when we productionalize and use for buy side advisory and diligence, if that's really an avenue for us to grow. And I think that it's kind of twofold where yeah, these were originally folks that I was reaching out to be an investor. Um, and having seen kind of how the sausage is made on the sponsor side of the equation,
Mm.
um, I'm really interested in shifting over and better understanding, how I can help these independent advisors and family offices build out their alternatives capabilities.
Right.
In the meantime, I'm focused on consolidating my ownership within my real estate investments. So I have some
Mm.
LP investors
Mm.
uh, that have been along for the ride with me since 2022. A lot of the properties that we have in our portfolio, I want to hold on to. And so as we start selling some of these properties, I think my game plan is to really go back to some of these LPs and see if they'd be interested in some liquidity in being purchased or letting me purchase their equity.
Mm.
And this
Mhm.
is so I can have this fully controlled, unlevered, cash flowing portfolio for when I go to market on another fund. Um, and it just is a lot of leverage in those conversations is when
Yeah.
you're able to make a significant contribution. And when you have some cash flowing real estate already in a fund, so folks are investing on day one into yielding investments.
Okay. All right. Daniel, you've built your career around, data-driven decisions. Is that accurate to say that? Um,
Yeah.
yeah, I mean, okay. And if you had a magic wand to fix just one thing that might be holding back institutional grade residential real estate investing from achieving its full potential, what would that one thing be?
Ooh, promotes.
Okay.
Yeah, I think the so a promote is a for the listeners that may be less that may be interested, but promote as in a profit incentive for a sponsor. Traditionally it's I'm a sponsor, I'm going to put 2% of the total equity into a fund and returns above 9%, I get 20% of the excess. So it's
Mm,
this like outsized return in a positive investment. And I understand why the system was created at first. Because sponsors are doing all the work, they're providing sweat equity, and there are people with a lot of money. And so the people
yeah.
with a lot of money, they want to properly incentivize sponsors. But this has been around since, really when private equity was created. And what's kind of transpired over the last decade or 2 decades, I would say, is sponsors are now just absolutely insane with the way that they charge fees. Promotes have gotten so far out of whack. And there are funds that I'm looking at. I'm doing like a fee stack analysis for folks on, okay, this is a Reg A non-traded REIT that you want to put some of your clients' capital in. Let's take three of these, and I'm just going to show you the fee stack. And if you're right
Mm,
about multifamily in the Midwest, the fees actually are going to be pretty important in terms of picking which is going to be the best investment. And reading through these and actually modeling them, it has gotten so insane. And these big blue chip institutional sponsors are charging so much. And then you have these small sponsors that believe that that is the market rate. And it's just so out of whack. And I feel like if they would have actually addressed this earlier on and created a better system, we
mm,
wouldn't have so much animosity between sponsors and LPs. And I think that we've been in a golden euphoric period from 2015 to 2023. And
mm.
folks are feeling pain in the more recent years. And so this sort of animosity is going to grow. And so I really do think that there's a better system or there's a better way to align incentives than promote structures. Uh,
Okay.
but truthfully, I've been a sponsor and I use a promote structure because it's what people want to see.
Yep.
Uh, yeah. But if I have a magic wand, I would take away promotes.
All right. Thank you. Thank you, Daniel. So, do you think that this is an industry-wide issue? I mean, uh, is it
It's
more?
one of those, it's like when I teach class and
Yeah.
I talk about EBITDA, everyone knows EBITDA is not a true measure of cash flow.
Hmm.
EBITDA is this kind of made up fake finance accounting number. But the
Hmm.
reason why it's used and the reason why it's continued to be used and the reason why it will continue to be used as a valuation metric is because it's been used since we started doing valuations on public stocks. And so there's just so much comparability
Mm.
and there is so much data to back up this sort of valuation that it is the best way to approach the majority of M&A is on this
Hmm.
EBITDA metric. But if you asked a private equity partner, if you asked a third party accountant, if you ask the management company that's selling their platform what EBITDA is, they're all going to give you different numbers.
Mm, okay.
And so I think similarly with Promote, it's just one of these things that has just been around for so long. And
It,
it's almost like it's been changed in a way or adjusted in a way to fix a problem. And if we just came up with a new way to align incentives, maybe we wouldn't have a problem.
there we go. All right. So, Daniel, that was incredibly insightful here. Thank you so much for sharing your expertise in that particular area. And yeah, so do you see it evolving soon here with sponsors relenting and charging less? Is AI going to assist in that process to make something more fair? Uh,
No. I
okay,
wish I
all
could say
right.
yes. I really do. I don't have a doomsday perspective on AI, but I do think just again being on the L&D side and seeing how bigger places are treating this versus smaller places, and I genuinely think the next 10 years looks like is you're gonna see smaller deals being done by bigger people. And there's always been opportunities for alpha in the middle market and the lower middle market. But big financial institutions, they can't rationalize these purchases. It takes too much time, or their fees are too high,
Mm,
um, or they should be prioritizing bigger deals. And I think with AI, that problem kind of goes away. That
yeah.
now at name your bulge bracket bank, I can staff one or two people on a deal and provide them with an AI junior. And
Mm,
now all of a sudden I can take on these smaller deals. And you see it at least in transactions in M&A world that a lot of big investment banks that would only work on billion plus transaction size uh, you know, acquisitions or investments are now building out middle market groups.
mm,
And I was in the middle market, and a lot of middle market companies are reliant on referrals from bulge bracket banks for deal flow.
yeah.
And so what happens when these big banks are able to work on smaller deals? I
Mm,
think it really just kind of takes out the middle market. And so with sponsors and promotes and institutional investing, I think that big platforms are going to be able to work on more niche things. They are also going to be able to work on smaller transaction sizes.
hmm
Uh, and so for these bigger institutional platforms that have publicly traded stock, you can't change your pricing model.
mm, hmm
It would have some big ramifications in the markets. And so I think that it's here to stay. I do also think that there's an opportunity, though, for unique, bespoke models. Folks that are really good at doing one specific thing over and over and over and over again, that don't have the same glut and bureaucracy and back office as a big institution. So you
mm,
don't have to charge the same level of fees.
mm.
I think those platforms are going to be well positioned, but I cannot imagine a world where a big institution that's gobbling up market share decides that, yeah, I'm going to lower my fees because I want to
Mm.
make sure my LPs are a little happier.
Oh. Okay. Very good. Very good. Thank you for your insights today, Daniel. It really needs more time, I would say, to dig in. You've got tremendous experience and insight to share with people in your niche there. And I'm looking forward to perhaps a follow up down the road here. And I want to thank you so much. And where are people going to find you, Daniel? Yeah,
Yeah, so
yeah.
you
Go
can
ahead.
find me on LinkedIn. I'm very active there. It's actually my only social media. Kind of like Fernando Mendoza with that. And then you can also find me on my website, emcapllc.co. That's a great way to get in touch with me. But really, if you're on LinkedIn and you send me a message, I'm more than happy to speak to people. Like I said, I
Wonderful.
think it's my job is to talk to the market.
Wonderful. Thank you, Daniel, so much. This has been very, very insightful. So there we have it. That's a wrap. And